thinking of buying your first home or upgrading to a more spacious one? Let's break down the real monthly cost and see if it fits your budget. The truth about home ownership: everyone profits: agents, banks, insurers, and governments. Except you, no matter if it's a good or bad purchase. Make your decision wisely: federal, provincial, and municipal. Governments encourage home purchases to generate ongoing tax revenue. Real estate agents, lawyers, home inspectors, builders, and developers all earn fees, commissions, or profits from your purchase. Financial institutions benefit long-term by earning interest and charges from your mortgage, often for decades, while insurance companies profit from the premiums you pay for home, mortgage, and title insurance. Since everyone involved in your purchase benefits, whether it's a good deal for you or not, they have an incentive to push you to buy, even if it's not in your best interest. Governments keep lending rates low for some time and ease home buying rules to encourage more people to purchase homes, support economic growth, and ensure a broader base of taxpayers paying ongoing taxes, fees, and charges. Real estate agents may first show you a few overpriced or unattractive homes, then present an average-priced property as a great opportunity or good deal, encouraging you to make an offer by making it seem especially attractive in comparison. A real estate agent or builder may arrange a mortgage broker, home inspector, and lawyer to push the deal through, overcoming financing hurdles and downplaying property issues to sell you a property they want, even if you can't truly afford it, or the home has significant building or legal defects. A mortgage broker recommended by your real estate agent may encourage you to take on a much larger mortgage than you can realistically afford, sometimes by inflating income documents or arranging high-interest side loans to make the purchase possible, putting you at serious financial risk or even bankruptcy in future. The home inspector you hire, who is supposed to identify current or potential future defects in the home, may downplay or overlook issues to favor the real estate agent and push the deal through. A lawyer may downplay or overlook legal issues with the property, such as easements, complex liens, ongoing legal disputes, or city-mandated modifications, to help push the deal through. In short, never rely on a real estate agent to arrange your financing, home inspection, or legal services. Instead, find these professionals independently, online with top reviews, or through trusted personal recommendations. Key inputs for home buying calculation: home price gives the total cost of the house. Down payment, usually 20%, gives upfront payment to reduce the mortgage. Mortgage amount gives home price minus down payment. Monthly property tax gives based on local tax rates. Monthly maintenance, condo fees gives if applicable. Monthly bills gives electricity, water, gas, insurance, etc. Mortgage interest rate gives current rates for fixed or variable mortgages. Understanding mortgage costs and payments. Mortgage types: close or open, fix or variable, 3 or 4 or 5 year terms, etc. Amortization: 20 or 25 or 30 years. Taking mortgage from banks, always safer if unexpected things happen down the road. A pre-approval shows the maximum amount a bank may lend based on your income and existing debts. The actual mortgage amount a bank will lend you may be less, depends on bank's appraisal of the home you plan to purchase. The actual mortgage is typically capped at 80% of the bank's appraised value of the home, not the purchase price if it's higher, or not the pre-approved amount. That's why including financing conditions is critical, as the final loan amount depends on the bank's appraisal. Monthly interest-only amount equals mortgage amount * interest rate divided by 12, monthly total cost of owning, equals sum of all costs plus including interest-only amount. Monthly mortgage payment equals principal plus interest gives. Principal builds equity or savings. Affordability. A common guideline for cost of accommodation is gross annual income times 39% divided by 12 to estimate monthly affordability, which banks often use when determining loan amounts. Consider monthly take-home salary or net income, cash required for living, entertainment, and savings without major impact for current lifestyle. Tips and final advice: always make a conditional offer, including financing and home inspection. Use online calculators to double-check your affordability numbers. Keep a financial buffer for emergencies, closing costs, moving costs, and unexpected expenses. Think long-term. Consider whether the home will remain affordable over the next 5 to 10 years, including potential changes in your life and career. Make sure you can comfortably afford your mortgage payments, bills, and other expenses, even in the event of a job loss, or if a partner or tenant who helps cover these costs moves out or stops contributing. If you need to sell your home within a year or two, you will likely lose money spent on closing costs, moving, commissions, and other expenses.